One of the books that I read freshman year in college was Rich Dad, Poor Dad, and it had a huge influence on my life. It actually was like the reason I went into finance. But one of the things that he talked about that stuck out in the book was the power of a C corporation. So Alice and I are doing a four-part series on C corporations for the next 4 weeks. This is the first installment. Let's get into it. This episode is brought to you by Rife Martin CPA and Stonehill Wealth Management. And let's get straight into it and talk about this money and C corporations.
Show me the money.
Show me the money. What's going on, Allison?
Gosh, it's just the first full week of like summer. Don't you feel like today we're past the April showers, bring May flowers. We're here into some more showers. So let's see if we can shower down some rain onto, what is it, the corporate shell.
Let's
Why
make
would
it
we want to
rain.
choose a C Corp?
Let's make it rain on C corps. Let's talk about it. So we'll do it. I got three good questions for you, and I like this topic because I feel like a lot of people are into entrepreneurship. I think entrepreneurship's been a trending thing for the last decade, and so now I feel like at least in my circle, you have some entrepreneurs who are making like some real money now, and they started off as one structure. Now they're thinking about a C structure, right? Because of maybe they want to raise money, maybe they want to get bigger. Just lots of things are happening, right? And so C corporations are a good thing for us to talk about. So let's go straight into it. What's the core difference between a C corporation, an S corporation, or an LLC?
So I will say we'll be talking about it from a tax perspective because you and I clearly can't give tax legal advice on the legal impact of it. But, a C Corp versus an S Corp versus like a single member LLC. So a C Corp is a separate entity, much like a C Corp or an S Corporation. However, the big difference from a tax perspective is that the income tax, any profits earned at the C Corp level are paid by the C Corp, while the S Corp, which a lot of small business owners have, it passes on directly to, and is taxed at the individual owner's level. So again, and the tax rate on a C Corp is flat at currently it's at 21%. So obviously, if you're going to make $100, you're going to pay 21 bucks in tax. So that's really the big difference.
Got it. And those are both separate from LLCs. What's the big distinction between those two and like a LLC?
So an LLC, typically that's like used where it is a separate entity from you, the individual. But most of the time, those LLCs, if it is a single member LLC, it's taxed. The income earned from income profits are earned taxed on it on your Schedule C of your individual tax return. If you're a multi-member LLC, taxed as a partnership, you would be again taxed as a separate entity, but your individual share of the investment or profits would be taxed on you personally.
Got it. And then with a C corporation, as I understand it, there's something about like you may be taxed twice. Like what does that mean, and what's the trade-off? Why would you, if you are taxed twice, why would you want to be taxed twice?
Well, I was going to say, why would you want to be taxed twice? So again, the profits are taxed on a C corp. Taxed the profits generated are taxed at the entity level. If you take out a distribution, you one of the shareholders take out a distribution, it is considered a dividend to you. So it is taxed at ordinary income rates for you personally. So again, there may be reasons to do it. Um, but if you, from a tax perspective, I would avoid it and have it paid, have you get your share of the income differently. Or again, maybe you realize there's no big deal in paying tax on the dividend because whatever your personal tax situation is. But there is that big concern of double taxation for you to consider if you take a distribution out.
If you take a distribution out, so that's like the triggering event.
Correct.
Okay, got it.
And there are some tax strategies to mitigate it in that you could maybe become an employee, depending upon the work and your level of shareholder, you could conceivably be paid as an employee and that's one way to legitimately get the money out, to have it paid as a salary. And again, there's other strategies, but avoid the dividend or distribution at all costs if you can.
Got it. And then so as far as setting up a C corporation, you do that with an attorney, right? And maybe I'll have an attorney come on and talk about that. But like from a tax standpoint, once it's set up with the attorney appropriately and properly, like how do you file different? Like how's it going to look on my tax return when I have a C corporation?
So the C Corp would file its own tax return. It's a Form 1120C. And then obviously if there's state tax implications, considerations, you would file a state tax return on it. But nothing would ever show up on your personal tax return as a shareholder unless you took out a dividend distribution.
Got it. So that's the different part too, right? Because you'll just show your salary if you work for the corporation, but if the corporation makes money, that's no longer going to flow through to you. It's going to just be filed on the separate corporation tax return.
And I will say the downside too is the loss doesn't flow through to you either. So if the C Corp generates a loss, that stays with the entity. Remember, with the S Corp or a partnership, any loss would flow through to you on the partnership or the S Corp or the LLC as well too, if you generated a loss.
Got it. One of the funny things I always think about when I think about C corporations, I always go to like when Mitt Romney was running in 2012 or whatever, 2011, and he was like, corporations are people. And I was like, somebody should have really helped this guy. Like,
Yeah.
that was funny.
No, they're not. But
Yeah.
because, again, while there's all kinds of strategies you can employ on a C Corp, if you are one of the shareholders, and there are some C Corps where you are the sole shareholder, there's some great reasons to do it. I would have a hard time thinking why, because wouldn't you want the money to flow through to you from a tax perspective, to flow through to you personally? But again, there may be some other reasons that, are outside of the tax consideration to do it. But I would choose the S Corp or the partnership from the tax perspective because you do lose, like I said, you lose the ability to potentially take losses if if one's generated.
Yeah. We're in our next episode, I'm going to get into a strategy and get your thoughts on it. Well, I think a lot of more people are going to be willing to do this. And so we'll get into it, and I'd love to get your thoughts. I wanted to use this one to like lay the groundwork for how it's taxed, and the next one will be strategy. So like if y'all got this one, you got the base understanding. So when we move high level and strategic, you can move with us. Let everybody know how they can reach you if they want more information about just anything about business, finances, and how to get rich. Talking to Allison.
Well, you can reach me at my website, rifemartincpa.com, or you can email me at info@rifemartinaccounting.com. And I'd love to talk about this or any other great topic as well, too. But this was a great episode and a great entryway into the benefits of a C Corp.
Thanks, Allison.
Have a great day.
You too.
Philip Washington Jr. is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.